Kevin Mofid from Savills is just going to give a sort of brief flying introduction through some of the key figures, and we can pick up on those, but I thought it was useful just to see where we are in the market. Over to you, Kevin.
Good afternoon, everyone. I'm Kevin Mofid, Head of Industrial and Logistics Research for Savills in the UK and Europe. I've got 6 or 7 minutes to give you a data dump of what's going on in the market at the moment. So this is speed research. If you want a copy of the slides, just email me. Very happy to share, but I'll get very quickly into it. First things first, let's set the scene with where we were at the end of 2021 in terms of the market dynamics. Across Europe, 40 million square metres of occupier demand, new leases signed, a new record. 62 billion euros invested in the sector, again, a new record. So, very pleasing numbers at the year end of 2021. I'll come on to where we are in 2022 now. But the first thing really to say is, if I was giving this presentation last year, all we would have been talking about were the tailwinds propelling our sector forward over the last 2 years. What we're now beginning to talk about is the headwinds, how strong they are, and how long they are going to last, and what impact they are having on the market. At the moment, we have an equilibrium in some ways that has been shattered by what was happening in the capital markets side of things. And I'll come on to that in a minute. First, I want to just show you something that we've launched recently, our second annual Pan-European Logistics Census. We launched this earlier in September, a huge survey. Around 25% of the respondents are occupiers, and there's some really interesting sentiment coming from what occupiers are telling us, and I'll just pick out a couple of key stats. First, half of the occupiers are still finding business conditions more favourable than they were in the year before. However, we have seen a rise in the number of occupiers telling us that the conditions are harder than they were before, much higher than it was in the previous year. However, what occupiers are concerned about has changed. Last year, they were concerned about the availability of warehouse space. They were concerned about how they were going to service home delivery. This year, they're much more concerned about rising costs. That's the number one factor. They're much more concerned about the availability of labour, and they're much more concerned about the wider economic situation as well. However, there is a dichotomy here. There is a contradiction, because the occupiers are saying, yes, things are harder, but what are we going to do about it? And that's pointing to investment in the supply chain, increasing the amount of inventory held, increasing automation, nearshoring, reshoring, supply chain visibility. All of these are good pointers for the rising demand for warehouse space over the next couple of years. And 90% of our occupier audience said they expect to take more warehouse space over the next 2 years. So again, a very pleasing stat. Take up. At the half year, we're at 20 million square metres. We'll have the Q3 data at the end of this month at a pan-European level. In the UK, we're going to be at around 10 million square feet, which is broadly in line with where we've been over the last 18 months. So again, we're not seeing a weakening of the occupier position yet at all. However, if you take one piece of data away from you today, away from this presentation today, it's this. The vacancy rates are the lowest they've ever been, 2.9% as an average. We're not yet seeing any trend upwards in vacancy rates. And if we just focus a little bit on rental growth, these are forecasts from Capital Economics, and they're suggesting 1.5% as an average. Well, I don't believe that to be true, because these forecasts are missing the link between vacancy and demand. Rents have never increased when vacancy has been above 12%. So we are very still firmly in a landlord-developer friendly environment when it comes to vacancy rates. And we can see that with the rental growth that we've seen. Take Prague, for example, close to 20%, and that market has a vacancy rate of 1%. So no surprise that we're seeing that rental growth come through. On the capital market side of things, Again, a very pleasing start to the year. At the half-year point, close to 30 billion euros invested. However, to be fair, about 70% of that was in the first quarter. We've definitely seen a tailing off, and that's going to be impacting pricing. In the UK, we've moved our prime yield from 3.25% to 4.25%, so a shift there, and we're going to see that shift across Europe. Lastly, a couple of points on the structural piece. This is a forecast for online retail. It was suggesting that we're going to get to 25% online retail by 2025. I think that now is optimistic, but I still firmly believe in the trend that online retail is going to continue. And then lastly, a point here about nearshoring. This is a fantastic data set, and it just shows the amount of companies mentioning nearshoring in their annual reports. And you can see that how that has exploded, particularly over the last 6 months. So I told you it was going to be speed research. I won't bother with the conclusions. You're going to hear some really interesting, timely debate. With that, I hope that sets the scene. I'll hand back to Richard.
That's super. Thanks very much, Kevin. And what we're going to do is give some applause for the speakers as well as they come up. So that's up we come, guys. Very good. Really interesting, Kev. Thanks for that. Lots of interesting things to pick through, Kev, from that as well. Yep. So just good to see, 90% is a huge number of occupiers planning to increase their space. So I think that's useful to see. Let's start with brief introductions. Just a minute each would be great. Michael, let's start with you.
Hi, I'm Mike Hughes. I'm CEO and founder of Verdion. We're a specialist developer, investor, asset manager, investment manager in logistics, only logistics in Northern Europe. Our principal markets are Germany, and in the Nordics, Sweden and Denmark. We also invest in the Netherlands, and we have some investment activity in the Czech Republic. 32 people, 5 offices, AUM of about 2.6 billion euros. We develop large logistics parks like iPort in the UK, which is a sort of $500 million investment, including a rail cargo facility. We just bought some land, a former RAF base to the west of Düsseldorf, for another 600,000 plus square meter development. We also have an active urban logistics speculative program across Europe, and we invest in value add and core plus opportunities where we see the opportunity to add real value. That's us.
Great, thanks. Chris.
Thank you. My name is Christopher Mertlitz. I head the international investments team for WP Carey, based in London. And WP Carey is a globally active real estate investment trust listed on the New York Stock Exchange, where we currently have about 25 billion euros in assets under management in 25 countries, 20 of which are in Europe. So very much diversified by country, by asset class, but very much singularly focused on a strategy which is to generate long-term inflation-adjusted income. We're very heavily invested in industrial, logistics, warehousing, and so, look forward to the discussion.
Great. Ingo.
Thank you, Richard. My name is Ingo Steves. I'm the co-founder of BEOS Logistic, member of Swiss Life Asset Manager. We are on the market since 20 months now, and we have a strong development pipeline. I can really claim that we are under the top 5 developers here in Germany.
Great. Patrick.
Of course. Hi everyone, good afternoon. This is Patrick Frank. I had GLP's activities in Germany. GLP operates, develops and invests in 5 continents, whereas in Germany we are about 1.6 billion square meter big, qualifying as us one of the bigger, not the biggest, unfortunately yet, development groups. So for the time being, we are 100% occupied, so we are fully let, and our strategy is clear. We just want to expand by securing new land positions.
Great. Balazs.
Hello, my name is Balazs Lados. I'm managing director for Realterm in Europe. Realterm is a 13 billion global manager in logistics real estate, and we specialize in a sub-segment of logistics that is transportation-related properties. In Europe, we're headquartered in Amsterdam, and we're invested in 7 countries: Netherlands, Belgium, Spain, Italy, France, UK, and soon expanding into Germany.
Great, Remon.
Thank you. Good afternoon. I'm Remon Vos. I started my business 25 years ago. And in the meantime, CTP is a 10 billion euro business. We have 10 million square meter of property in ownership. We plan to double that in the next 5 years. We employ 650 people. And we are active in 10 countries. Lots of 10s. And that includes Germany, Holland, and Austria. And all of the other 7 markets are Central European.
Great, so you can see we're representing an awful lot of space here in Europe and an awful lot of the geographies, as well as some different capital sources and different insights in terms of what's happening globally as well. And I'm going to set a rule, which is that don't wait for me to ask you. If you've got something to say, simply say it, irrespective of who I may have asked, so that we can do that. And the same is true of everybody here. If you've got a question, even if you're behind me, tap me on the shoulder, let me know, so that we can also ask any questions that you've got. And thank you to everybody joining us online. Similarly, if you've got a question, put it into the Q&A, and we will try and answer all of those. Let's just start. Maybe Patrick, with you, just to begin with. I suppose, how do you see big changes, obviously, quite recently, relatively recently? Normally I would say, how has it been since the last Expo Real? And there would be minor changes. But this time I could almost say, how's it been since last week? And there are big changes. But I suppose, how do you characterize that? Specifically, what does it mean for the logistics sector?
Well, yeah, based on your question, I think I can now talk for at least 30 minutes. So, but I said... very wide question, but I want to keep it short and sweet. To be honest, of course, everyone in the business, in the real estate business, in general, has been experiencing changes in capital markets, some level of insecurity. However, the logistical business, however, has been still benefiting from tailwinds in terms of demand that we've been lately seen, really helping us, at least for the 6 months, to overcome some of the issues that we might have been facing.
And Remon, just coming to you, it'd be interesting. You've obviously seen, you mentioned they're 25 years, so you've obviously seen a number of market cycles come and go. How does this differ from others? I mean, the interesting thing is that occupation levels are very high, as we've seen from Kevin's presentation. We've got a downturn in the economy. But the fundamentals for logistics still appear to be good. So how do you see those things working together?
Well, I'm very alert because there's so much change going on. So there's no guarantees that things are just going to continue and move on, and that all of our tenants continue to pay rent on time. So far they do. I think they will continue to do so, but there's a lot of things going on. So you need to be extra alert. I think you need to be very flexible, adjust to the situation, especially when it comes to funding. We've been able to use a window where we have issued bonds last year and the year before. That's gone, so you need to be creative on how you secure funding for the pipeline. So no, lots of things are happening, which also create a lot of opportunity. But I think we are not there yet. In the meantime, I can confirm, yes, we see growing demand. I mean, supply chain has been an issue. So what you see in return is that clients, they build inventory. So for that, you need more warehouse space. It's good. We've seen record high occupancy. And because of that, you see rental growth. That's all very positive, and that is true. This is what we can confirm. This is what you can see in our numbers. If also you realize that we will stop shipping goods from Asia over to Europe, because point one is expensive. Container shipment a couple of years ago was $2,000, now costs $12,000 to ship a container from Shanghai to Rotterdam or Hamburg. But also you pollute. You don't want to pollute. ESG is an issue nowadays. In terms like friend shoring, near shoring, all of that mid-long term can be very good for our sector, our industry, the industrial property or logistics. It can also be good for Europe, especially if you take into account, on top of what I just said, near shoring, the whole energy sector, which we have to reinvent or build And so there's lots of opportunities at the same time. But I said, so far so good, but I remain very alert. And you mentioned what have I seen in the past 25 years. Well, when we had 2008, 9 and 10, we've also seen growth during that time. So we have seen also in terms of value add activities moving to Central Europe, as that was the most cost effective location. So I see good opportunities in our sector.
Okay, good. I mean, I'll start with you, Mike, on this, but also interested in anybody's view. I mean, you mentioned there the change from nearshoring had been obviously a big topic that we'd been focused on, but for sure now friendshoring seems to be as much of a a kind of buzzword as anything, and there seems to be much more kind of wind behind those sails, if you like. How is that potentially going to influence the market, Mike?
Well, just coming back to your first point about change, you know, we've had pestilence, we've had war. Well, we have a war. Clearly, the changes are extraordinary, and Raymond's point about being alert. This rather reminds me of that period in 2008, MIPIM. Looking at my career, when we had attendance at MIPIM at peak numbers, I think in March 2008. And then the crisis unfolded after that. And there is a sense of sort of unreality here. But I think the difference is very much about the structural change in the logistics market, which we've seen over the last 10, 14 years. And it really is a very different place. The diversity of occupier requirements, the diversity of the supply chain now is not what it was in the crisis times. And as you say, the occupancy is, occupational demand is strong, supply is very, very limited. In the northern European markets in which we work, it's not an average of 2.9, it's sort of sub 1%. Extremely short supply, and rents are rising. I saw in the presentation that the projected inflation in rents was about 5% in Sweden. Well, we're letting some space in Greater Stockholm, and we're getting 18% rent rises above underwriting just 9 months ago. So it's a very, very interesting time. So dynamic time, very different than the previous crisis. This is, I think, a period of creativity, but it all comes down to the fact the only way you can take advantage of that is if you are a specialist. If you're a logistics industrial specialist, this is the time now to create real value and make real money. And it may feel uncomfortable, it may feel difficult at times, but this is where the game gets interesting.
I can see Ingo and Balazs, you both want to come in on that. So Ingo, you...
Absolutely. I share your view, Michael, absolutely. The times for letting activities cannot be better than these times. We have friendly shoring, onshoring. We have the reconfiguration of supply chain, the resilience of for the occupier markets. Everything is driving the headline rents high, the incentives are nearby zero. Even indexed VPI index rental agreements you can achieve with great covenants because there is no space available. We have occupancy rates of 100%. Patrick, you described that your retention rate is at 100%. No? And if you have a vacant warehouse here in Germany, I think before you starting the development, it's already let. And as you described that, Michael, you have in Sweden 81% better than underwriting. It's maybe not that extreme, but we are in the double digits from the underwriting until we have the new lease in place. So from that point of view, it's fantastic. The fundamentals are super strong.
Okay, good. Balazs,
Yeah, I can only echo Michael's thought around this whole situation being an opportunity. If I look around this panel, we're clearly the new kid on the block. We don't have, a large portfolio here yet. We only have sort of 30 investments and the value of around 500 million. So, this opportunity we see now with never before experienced rent growth, coupled with rewinding the pricing clock to, 2018, 19. We don't know where it's going to land yet. It's a combination of a tremendous opportunity for people aggregating logistics. It's nothing we've seen before. And if you couple with that with, the weak euro to the dollar, we're in an attractive market today. It's, I think 2023 for any aggregator is going to be a phenomenal year. It's a good vintage for funds.
Chris, it would be good to pick up with you just any if Michael hands you the microphone, yes, I could see.
Sure, thank you. Look, I think this is a challenging year in many ways, and I think a lot of there's so much good going for the logistics industry. That's clear, and I think in the long run, by which I really mean the long run, the fundamentals are obviously amazing. But I'm somewhat more skeptical about what's going to happen in the next couple of months. I think the panel overall is very, very positive about the strong demand by occupiers and the strong development activity. And I think that's a little bit too over-optimistic. I don't want to be the negative one in the group here, but I think the impact, given the inertia that we're seeing in real estate and in developments, I think the effects that we've seen in changes in the capital markets landscape, that hasn't really fully arrived yet. And I'm somewhat more doubtful how that's going to play out in the next couple of months as that gets felt more and more in the industry. And I think one of the slides here showed that yields in the last 6 months in logistics compressed. I would really like to know where that data is from, because I think it's widening, and it has to. As a long-term investor, you want to care about preserving spreads. And if your cost of borrowing or if the cost of debt goes up by 200-300 basis points, what are you going to do? It's not going to happen by staying at the same yields, is the short answer.
Yeah, it's interesting. Mike, feel free to pick that up, but I'd also like, also then for people to pick up on that cost of financing element, what that means in terms of yields, but also actually what that means in terms of development.
Yeah, I mean, what I wanted to, the caveat to what I said was that creativity, that opportunity is about repricing. I mean, it's absolutely about extracting value, and land prices will fall. Sellers will have to smell the coffee and accept the fact that the landscape's changed. So in terms of creating value as an investor developer, it's exactly that. It's about buying well and extracting value in a period of uncertainty. I could not disagree with the fact that cap rates are moving.
Kev's coming in with a point of order, briefly. It will come in.
Just one point of order on that. You're absolutely right. The yield chart was for the end of Q2, and that data we're in the process of sorting for Q3. There's been a lot of change, and then just one other point on being over-optimal in terms of occupier requirements. One slide that I didn't put up, which maybe I should have done. We only have this data for the UK, unfortunately, but we keep a track of every single occupier requirement in the market. And from Q1 to Q2, they fell 3%. So the number of requirements fell 3%. When I get back home tomorrow, I'm going to be doing the analysis for Q3. So watch me on LinkedIn, because I'll post an update on what that's showing.
Okay,
it's just a sorry.
Sorry, Chris. Go ahead.
No, please.
Just building on what you just said, Chris. When it comes to optimism and dynamics, probably what we're going to see in the very near future is potentially a split between users in older, cost-inefficient facilities and those facilities who just meet all the requirements in terms of sustainability, in terms of cost efficiency. And I truly believe that we're going to see sort of a separation between those two, well, not asset classes, but asset types. And I'm very convinced that the modern spaces, the newer spaces, will still maintain their value. And I'm very convinced that the modern spaces will maintain the demand they just need.
Yeah, absolutely. Patrick, what you have described, I see that in my business case. No? We have agreed with the Life asset managers that we have from 10 deals, 9 of them are speculative. I tried to be speculative, but I failed. No? Because after I've started the development and with the help of BNP Paribas, Realterm, for example, we stabilized before we even started the development, and even better than underwritten. And capital value, you will, even if you have decompression, if you have a good rent, the capital value will be the same. That's the phase. You need to look at the covenant and the power of your location. We have the situation here, for example, in Düsseldorf, where we have oversubscribed our spaces 4 times. And that is the opportunity for us. We would like to be green. We would like to have green leases, for example. And if this covenant's not accepting these green leases, we take another one. We're accepting this. So, again, great times.
Okay, good. I just wanted to, did you want to come in on that, Balazs? Feel free to. Remon, I just wanted to pick up with you, if I can, the friendshoring aspect of it, because that would suggest, what you mentioned there before is that, there may be processes that were done elsewhere, be that China or Asia, that may then come in. Does that mean that although people may be concerned from a political risk side at the moment about areas like CEE, that actually those are areas where potentially some of that manufacturing may go to, and so investors' concerns about that may be wrong, and that in fact there's potentially growth in those areas? How do you see that?
Yeah, good question. I think there's a lot good about Central Europe. And if we stick to the German market, for example, CTP, we're building stuff on the west side of Poland, which is along the German border. And there you can still easily build a 100,000 square meter shed or a 50,000 square meter shed, which I probably lease for €3.75 or €4. So very affordable. So that's one of the advantages of Central Europe. So what I'm trying to say with that is there is still the governmental support to allow these type of developments, industrial logistics, government support, infrastructure newly built, construction costs at a reasonable level, and that's why you can offer very attractive rates. And if you then look at labor costs in Poland, 1/3 of what they are in Germany. That's the labor cost, and then you can look at productivity and different kind of things. So this is just to illustrate what good is about and how attractive is actually our Central Europe can be. That's this side. If you go to the other side of Central Europe, you end in Bucharest, and that's half a day drive from Istanbul. So you can also think, okay, I go to Bucharest, like IKEA, I've done a project for them. And IKEA ended up in Bucharest, not because of the Bucharest or the Romanian market, but much more because it's a hub for them to supply Istanbul and even further on, and to Bulgaria and to, of course, the rest of Romania. And this is logistics, e-commerce kind of, which is half of our business. The other half is manufacturing. So, and you have different industries, less automotive, 20% of our business. Automotive as well is an industry which had to reinvent themselves, right? So from the traditional car, you now go electric. Everybody supports that. So then you have to anyway build a new factory, and let's do that in Central Europe. And that's what we've seen. And that's what Daimler do in Hungary and Audi do in Hungary. But you have other car makers, also Asian car makers. They don't produce cars in Korea or in China. No, they have a factory in Central Europe. Nothing bad with that. And you need a lot of suppliers to that. German automotive business, etc., etc. So there is there is a lot of opportunity. So friendshoring also means for Asian companies, if they want to sell here, e-commerce, any other product, they will have their facilities set up here in Europe or in Central Europe. And I think if, again, you want to nearshore, friendshore, if you want to avoid transportation costs or uncertainty on supply chain, Suez Canal was closed, we had COVID, we have a war, whatever, all have impact on supply chain, which is massive damage to the economy. If you want to avoid that, you build some inventory and you set up shop close by to where you consume. Driving distance. I mean, I drive in and out from Germany, Poland, Czech Republic, etc., etc. So yes, I do think there's a lot of opportunity. Why? Because of labor cost, labor availability, infrastructure, and the various different industries which will need new facilities. I mentioned automotive. I can talk about e-bike thing. I can talk about all kind of different things, which is, I think, a lot of opportunity. So I do believe mid-long term, we're going to continue to see strong demand for warehouse industrial property. Central Europe has certain characteristics. There are many different countries. Some have euro, some don't. Some have. There's a lot of different. You can't just say that's all goes for one. It's all a bit different, but there are definitely a lot of opportunities there, and together as an integrated part of Europe, they can be they can work well together and become a better Europe maybe.
Okay, good. That's interesting. I want to pick up a little bit on some of the challenges, certainly in terms of finance. Obviously, for a lot of the sectors that we've already discussed here. Challenge in terms of development, obviously, because difficult to finance, too much uncertainty in the market. What's the situation with the logistics side? I mean, does it mean that it's very difficult to do spec development now in the current market? Is it difficult to look at doing develop to sell versus develop to hold? What's the situation, and do we see that as a sort of temporary situation that will change? How do we see that? Does anyone want to pick up that development side?
Our business case, as mentioned before, was that we have 10 speculative development within the next 2 years. When I set up the business case, I was quite traditional a little bit, that we have in speculative development LTCs of 30%. But the banking market is quite very optimistic about logistics asset because of all the fundamentals we have already mentioned. I don't want to replicate that. Speculative development in Germany, you can go for 50% LTC. No? If you have the right location, if you have a track record, and you have a good backing, then it's possible. And we will do that in future times as well. No doubt about it.
Yeah, same here. Just rounding up what Ingo just said. We continue to develop on speculative basis. Of course, we probably might be a bit more picky when it comes to the location where we want to develop on speculative basis, but it's still part of our success story to continue that, even in the overall framework of massively increasing construction costs, higher demanding clients when it comes to sustainability, when it comes to cost efficiency. But there's no plan B. We just continue marching.
Okay, good. Mike, you want to pick that, and then Remon?
Yeah, absolutely. Now, a key part of our investment strategy is building speed to market product, quality product that suits clients that are looking to serve urban areas, and it's the fundamentals have got to be right. The location has got to be strong. If you're building speculatively, you're building a quality product that's flexible for any number of tenants who want to serve urban areas. You've got to choose your locations carefully, and you've got to build the right product, and you've got to get the fundamentals right in terms of capturing that rent inflation. It's quite an interesting one. Your development team want to build buildings and lease them as fast as possible. The tactical thing is how to achieve the best possible tenants and rental income on the best commercial terms. We all know how it is trying to hold the team down. Hey, don't jump to the letting that lands on your lap on the second day you're on site. So there's a real opportunity out there to capture that rental demand by building quality inventory stock in the right locations. And on that topic, where we are focusing is on infill brownfield locations that have existing infrastructure. They're typically close to urban areas and offer great potential, not least from an ESG perspective. Recycling, reusing existing sites is the right thing to do. It's also commercially practical thing to do. I think the other side of the coin is there. To do that well, you've got to have a strong in-house technical team. You've got to be a technically focused business. But if you have that, then there's a real advantage.
Okay, good. Remon, you wanted to come in, did you, briefly on that?
On the funding part, we spoke about it. Yeah, funding part, we've seen a lot of change there. I think it's the biggest change, honestly. So the funding, we used to go to the market, at the bond market, and we would be able to secure money, get money for below 1% 12 months ago. And now we need to find it elsewhere and cost 5%. So that's a different game. Which is the game which we used to play before we went to the bond market. But that's the major change. So, and then obviously for us it makes you think, okay, where do I want to invest? What do I want to buy? And how do I do that? Because you don't know, and so on and so on. So, but we develop to hold. So it's not ever that we sell anything, as you know, which is good on one hand. Now next year we collect 600 million euro of rental income, and most of that is cash which we use for new developments. And with respect to speculative developments, yeah, we do that, but we start and we don't need to complete immediately. So we are in most of the markets where we operate, we are our in-house general contractor, so our own construction company. So we start with a project, but we will not rush to complete until we have a tenant to avoid you build for vacancy, which you don't want to do. So it's very much to be alert, to be on the market and to see what's going on there. Yeah.
I feel like for several years, like a lot of these logistics developments, this kind of worked because you had ever decreasing cost of capital, and that sort of preserved a low rental level, given that you were still able to build despite construction costs increasing because yields just went lower and lower and lower, and you were still able to sell those deals. So I think the way I look at it, we almost need to slightly separate here let's say the tenant occupational demand and then the way an investor would look at that. I agree that from an occupational perspective, it sounds like the market is still doing very well. There's very low occupancy, there's clearly a lot more demand than there is space, which means rents are going up. That all makes sense. But I think now that we're in an environment where we have still increasing construction costs, or at least we saw very rapidly increasing costs, maybe it's slowly stabilizing now, but it feels like with the massive increases in energy costs, we're seeing also for steel, for cement, these costs again filtering through into increasing cost of construction. But then you combine that with the completely different environment that we're in from a cost of capital perspective. And again, if you multiply your cost of construction with your interest rate, you're going to end up with a rent level that, at least relative to historic rents, is going to look very, very different. And I agree that the rents are increasing, but I'm not seeing that they're increasing at a speed that would preserve capital values in an environment where capital yields or yields and transaction yields are changing much quicker. So I think there's a certain runway and there's a certain lag in the system. And yes, there's still a lot of demand, but I think we're looking into a slightly deteriorating economic environment.
Yes, Christopher. We had this discussion already in the prep call a little bit. No? You see, we are very optimistic about the asset class. I think any investor has an issue if they don't have that much logistic in their portfolio. That is my point of view. Inflation is now for 2-3 years, we have it now, 5-6%, maybe 10%. No? But our customers have that on their turnover side as well. No? They can bring that to the consumer side, 10% as well. So the overall relative cost for our customers is the same, 3 to 5%. No? So it's an easy environment for us to get better rents. No? And what I have seen is now that it's the first time since I'm in the business that this tracker between GDP and the ask for headline rent or the ask for space is no correlation anymore, because we have all this kind of stuff, consumer resilience, e-commerce, friendly shoring, onshoring. So the rental growth is there, even if we have maybe a kind of recession. The ask for space will be there.
Yeah, again, just to build a bridge again between the two of you. Again, we have to say, and we have to confess the fact that we are coming from extraordinary times. Extraordinary times in this sector of real estate in terms of cap rate compression, coupled with steady rental growth. So it was just, you couldn't get better at the end of the day. And this is something I believe everyone has to appreciate, the fact that these were extraordinary times. And when we are now heading back at least a little bit towards time that we would consider as normal, I would think we are still on the very safe side of the business.
Okay, Balazs, feel free to pick up some of that, but I wanted to come to you because you relatively new in the market, looking to grow your portfolio. A lot of focus, I'm guessing, on sustainable product, or are you looking for core product? Are you looking for, does it have to be sustainable? Does it have to have all of those things? Is energy a growing important part of how you're looking at that energy sustainability for each of the buildings? What are you looking for specifically from an investment point of view?
Yeah, so our investments are organized into a core plus open-ended income fund and a value-added closed-ended fund series. So both strategies are a little different. In a value-added fund, you buy, fix, and sell assets, existing properties that are, that have good functionality, and we put a lot of money into turning them into modern Class A facilities that have all the sustainable features you need. Typically what tenants want is, insulation, energy efficiency, and nowadays it's on-site energy generation that they can use for vehicle charging. On the core fund side, it's natural that you want to buy, the best quality product, and you need to have some kind of a strategy to carbon neutrality. It's something that your investors want. It's something that is regulatorily happening in Europe, and it's something that your banks want to do. So you can no longer just hold assets and do nothing. It's not a luxury we have anymore, and we put a lot of emphasis into coming up with the right strategy in that regard.
Okay, good. And is everybody agreed on the ESG is absolutely key, and that's become more so over the last 2 years? Yep. Any?
Yeah, I mean, obviously ESG is a somewhat trite expression in the way it's used now, and we must be careful not to fall into the trap of virtue signalling, Richard, as ESG is as much about social justice and wider human issues. But in terms of, are we creating product which was respectful in every possible way, including the energy performance and sustainability of our buildings? Yes. And that's absolutely a driver in everything that we do, and will continue to be. I can only see that demand and that need increasing.
And so the key point there, I suppose, yeah, feel free to pick that up. The key point there is we will then get a bifurcation in the market between those that do have those sustainability credentials and those that are slightly older and don't.
Yeah, and I think the shift is towards a view on total occupational costs. So obviously rent is one element of that, but clearly another one is energy. And with the way that energy prices have gone, it makes a lot more sense. It was almost an afterthought for a long time, but right now I think that's what the market is going to shift towards. What's my total occupational cost of running this space? And it should be that way.
Yeah, maybe I can add to that. I mean, what we did when we did the bond market, we certified our portfolios, all BREEAM certified, of course, and that was in line with the standards we built. ESG is important. I fully agree with you. It's not just about solar energy and those kind of things. It's also about the S, social. So we build affordable housing. We have a clubhouse. We have medical care on site for free in some of our parks. But we do simple things like picking up stuff from the forest, which is next door to where we have our development. We offer education programs, and we really connect and integrate to the community where we invest. Because I have examples where we started 20 years ago, we're still building in the same project, and it's very important to us that we connect and we are good for the communities where we operate and integrate. So, and that's also a nice thing of what we can do with our parks and projects, and that social responsibility and all that ESG related stuff is, I think, super important. On top of that, yes, we also get requirements, and we do also a business case, by the way. And we are just extended or increased the investment in solar energy, another 100 million euro for next year. And this is with installing rooftop solar plants to create energy, which we then use in the park for our tenants, which obviously is great for them because it helps also for them to hit their ESG targets, which they need to comply with in order to continue supply to their clients. So it's we are just a part of the whole bigger thing, which is good to be part of. Yeah, so we take it very seriously.
Great. Balazs, you want to?
Yeah, one theme that we've been seeing from users and tenants is getting rid of gas completely, and it's the kind of the LED lighting topic, like back in the 2017-18 where the cost of the technology was still hard and then still high, and now converting gas heating to electric is a pretty substantial ticket. So any of us landlords will need to have sort of those conversations with tenants, and it's at least 100 euros a square meter. So who's going to finance that? That's a pretty critical thing going forward, and those are conversations I think that everyone in this panel will have.
Okay, good. Does anybody have a question? If they do, you've got about another 30 seconds to think about it, and then I'll be coming to you. Just in terms of locations, just a quick look at where we see, I suppose, opportunities. Is that across Europe, or are we beginning to focus on different areas? For example, has the UK seen more of a downturn? Have other areas picked up? You know, has the Netherlands picked up because of Brexit, or has Brexit created more warehousing logistics opportunities on both sides of the channel? Any thoughts in terms of locations, some that are hotter than others?
I'll only add that we see particular growth and opportunity in that edge of urban locations, serving urban conurbations, B2C business, speed to market business. That we think is a particular growth segment with particular opportunity for rental growth and occupational demand, as opposed to bigger boxes in bigger box locations. That's where we see a differentiation, not only in quality of the building, but the type of product and where that product is placed.
Okay, now that's interesting because you've just launched the big box strategy.
Yes, absolutely.
So it'd be interesting to get your perspective.
Yes, absolutely. I think in our first development pipeline, about 600,000 square meters of land we have bought or developed now. We have a mix of greenfields development and brownfields development. So you can take care about your customer-centric business who needs nearby the cities, or you need to be having a big logistic hubs. No? That makes sense. Not only concentrating on last mile, I don't think that's the right strategy. You need to have a mixture of it. No? That makes you very interesting for your customers, no? That you have everything in place. No? One of our biggest customers, we know we had last mile sorter center and e-fulfillment center. No? So we have big boxes, multi-story boxes, we have sorter centers with a clear height of 20 meters, and you have last mile logistics. No? Just, I would like to add one topic on ESG. It's absolutely, from my perspective, or from our perspective, and backed by Swiss Life asset managers who are 165 years in the market, it's our DNA, no? That we have here a very sustainable development pipeline. We have absolutely no gas free, we have solar panel, we have geothermy, we have everything what is needed to be sustainable in that respect.
Good. Let's just finish off with, it very plainly says outlook and opportunities. We've done a lot of outlook. We've talked about some of the challenges. So just one each. Let's start with you, Mike, and work our way down. Key opportunities that you see in the market at the moment.
Thank you, Richard. So I'll do it in bullet points. Brownfield, infill, edge of urban, recycling, focusing on that last mile or edge of urban customer. That's the opportunity that I see over the next 4 to 5 years.
Okay, good. Chris.
WP Carey is an all-equity investor, so we don't really require or seek, in fact, any kind of bank financing for investments. And I think as we enter a new period that is certainly much more capital constrained, I do think that outlook will be quite favorable for opportunities for all equity investors like ourselves to find new stock and to find good investments. So in a way, cautiously optimistic, but yeah, look forward to some good years.
Absolutely, Christopher. That's my point as well. I think now it's the time for equity strong investors buying good stuff, good portfolio deals, and for being a developer. We have equity now to go really in land banking, and that is where we are focused on the next up to 3-5 years.
Yeah, just echoing on what Ingo just said. You know, capital strong companies still have a lot of opportunities out there, but key is as any time is just a land position in good locations. We have to be ready to to buy smaller plots when you want to move closer in direction those bigger conurbation. So the times of developing a big box to big cities is unfortunately over.
Balazs.
Continued very strong rent growth in land constrained locations, very rapid repricing in the market, and less competition.
Okay, great. Remon.
Yeah, opportunities for the next 5 to 10 years are energy, Central Europe, affordable housing. Yeah, and that's the rest I keep for myself.
Are you going to fit those all into a logistics hub, I wonder?
I do my best.